We'll talk about the Dow theory now, and Dow theory is most important foundation of technical analysis. You'll find a lot of material on Dow theory, and it is something that you should just quickly read through at least once a year, just to revise, because this is 150 or 200-year old science that has been created, and it has been adapted, improvised over these years, and it is really a basic foundation and very important foundation of technical analysis. So the Dow theory, you know, it basically relies on certain assumptions. Okay, it assumes that markets discounts everything. Okay, and what we mean here is all the information, all the news, which will your charts or your technical setup will always tell you upfront. Okay, for example, in the crash of coronavirus outbreak, okay, we know that the lockdown was announced in India in March. Okay, everything fell for 8 or 9 trading sessions, and after that there was a very strong reversal that had happened. So did the in those 20 days, everybody was anticipating that there would be very concerning issues related to COVID, and economy is going to turn bad. So everybody knew this, but market will discount everything. Market will run in anticipation that economy is going to go good. Okay, so when cases started increasing, way before that market crashed. Okay, and way before the vaccine has come, markets have bounced back. Okay, now if market crashes, so it would be for some different reason. Okay, now we have noticed that even during after the crash, certain sectorial stocks were performing well. Okay, even hotel stocks gave a run sometimes, because markets were anticipating that with the unlock that was happening in stepwise, market discounts that news, that because it is going to happen, the rally was done before the actual news came in. We know that also the Dow theory tells that there are overall three broad market trends. One is the primary, second is the secondary trend, and the minor trends. So when we talk about binary is basically short-term trends which basically last for a week or two. Then there's a secondary which basically lasts for couple of more months, like 6 months or 7 months. So the current correction went on for almost 4 or 5 months, so that is a secondary trend. So if you check the Nifty chart on monthly charts, you can clearly see the primary trend is still up. Okay, so these are three broader market trends. It also assumes that all indices, okay, must confirm each other. It won't happen like your Nifty is going up, but IT stocks are constantly going down. This might not be true. There could be only very few sectors which might not be performing well. But if let's say Nifty is going, so let's say Nifty has a strong slant like this of let's say 45%. So other indices might be something like this. IT stocks would be like this. Let's say real estate could be something like this. But overall, if you see that almost all the indices would be going in the upward direction. Okay, when they start going down, so maybe this sector would go like this, then this, okay, then this maybe, and something like this would start happening. Okay, so sooner or later they are going to follow a same trend. Okay, we also know that the closing price is the most important thing in the stock market. Why that is important is because over a period of time, okay, we might neglect information like what happened on Monday 1 p.m., where was market at Monday 1 p.m. So that information might not be correct, but what happens across all days at the end, that information is more important. Okay, so now from this chart you can see that the trend is up. Okay, now what happens on a certain Monday is not nearly significant. Okay, or what happens on a week is not significant. What matters is what is the overall trend. Okay, so closing patterns matters the most. So all these points are closing points of that particular day.